everyone who comes to Johannesburg, I take them to Jewel City to see that development, and now to Barlow Park. And between the two of them, they've been at perhaps a wider network of colleagues and investors as well, but both very prominent in driving this argument for investment in multifamily residential rental. And it's really changing the face of our cities in South Africa, and very inspiring for investors coming from other places too. So I'm so excited you're going to share this today. Please go ahead.
Thanks very much, Kessia. Afternoon, everyone, and I suppose we're into the super graveyard shift, but we'll try and make this as interesting as possible, so we'll try to be interactive. And I think if there are any stories that anyone wants to share or any comments as we go through the presentation and the talk, then just pop up a hand and we can chat openly about it. But simplistically, I suppose Cara and I, over the last 5 to 7 years, our jobs have involved the thankless work of trying to raise equity in a very difficult property market. As Kessia mentioned, I work for SAMRA. I was given the position of jockey of that association at the end of last year, so I've been there for about a year or so. And what that association represents is the multifamily residential rental market in South Africa. We consist of about 14 members. In terms of apartments, it's about 80-odd or 85,000 apartments with a national footprint. In terms of value, you're looking at, my maths isn't always great, but probably about $3 billion worth of real estate value. And where we positioned in the market is very much in the affordable space. So naturally, in South Africa, where there's been large-scale rollouts of residential property, and where you've got landlords or single-owner landlords in the market at the moment, naturally they're positioned in the affordable housing market. So you're looking at bands of anywhere between 500,000 to R1 million per unit. So again, in dollar terms, probably between 25 to 50,000 US dollars per apartment or per home. And our association, when we speak about multifamily, the important differentiation there is very much around rental and assets that are held over the long term that provide sustainable, consistent returns to shareholders for rental purposes. As mentioned, I was previously CEO of Transcend, which was a listed REIT, a specialist REIT on the Johannesburg Stock Exchange. We recently delisted, and I think that also is maybe an element of conversation we can unpack as to the rationale behind delisting the REIT in the last 12 months and where the market is, but also gained huge experience around access to institutional capital, and as I mentioned, going through the job of trying to raise equity through what was a very difficult market over the last 5+ years.
Cool. Good afternoon, everybody. My name is Carl. As Kesha mentioned, I head up diversity. I've also got one of my directors here, Mr. Paul Jackson, who I believe many of you know. So diversity is, as Kesha mentioned, a developer, owner, and operator of affordable rental housing. We currently, it's kind of hard to count exactly because a lot of stuff is in development, but let's say we've got just over 8,000 apartments currently kind of in this under management with tenants in them, and then there's a good another 4,000 or so on the way in the next 12 months. So the business is growing rapidly, and it really, I think, reflects this maturation of residential rental as an investment grade asset class in South Africa, and we're going to get into that a bit now. So we're kind of fortunate to be there while this industry is really taking off in South Africa. I just want to quickly get a sense of who we've got left in the room here. So who here develops property? If we can just do a quick raise of hands. Okay, I'm going to guess that's about 10% of the audience. Who is in the debt capital market? So banking or anything debt related? Mr. Jackson over here, got a few more. And then who is on the equity side of the equation, whether that be private equity, DFIs, or pension funds? Very little equity. Okay.
So we've all got the same
yes.
problem.
So real estate is hell of expensive. And there's been fantastic discussion over the last 2 days around, all the various challenges that the industry faces, and whether ranging from sustainability to alternative, building technologies and materials, how to go down market. And these are all incredibly important challenges that we need to collectively solve and work on. But at the end of the day, real estate, and specifically housing, is the most expensive thing there is. And I just want to qualify what I mean by that. The largest asset class in the world is real estate. 40% of all capital in the world is in real estate. There's nothing else that comes even close to that. And within real estate, the largest segment is residential property. And any of you can anecdotally, arrive at the same insight if you just look out the window when you're driving along a highway in any city in the world, really. Cities are mostly houses. So where am I going with this? I think part of the incredible importance of a conference like this is that essentially, if we want to get our cities right, and if we basically want to get development to really take off in emerging markets, such as most of the economies on the continent, this is fundamentally and intrinsically a housing problem, basically. This is the biggest thing that we need to spend money on during in our lifetimes, and especially in this kind of generation where this incredible expansion of the urban environment and of cities will be taking place. So this money needs to come from somewhere, and part of the argument that we'd like to make today, and some of the kind of data we'd like to share with you, is specifically focused on this question, effectively, where does the money come from, but specifically, why would pension funds be a very good source of capital for rental housing?
And I mean, maybe the overarching question is how many people in the room struggle to partner or gain access to institutional capital at the end of the day? So by a show of hands, developers, bankers, and I suppose this is the biggest problem, or the most systemic problem, is actually finding appropriate capital to roll out housing within the continent. So we can hop into the slides. What we've done is, and this is very hot off the press, the slide deck, so excuse any spelling mistakes, but what we've done is we've just set a high-level framework to the discussion today. I don't want to focus too much on the first two big bullet points, the market runway and the barriers to delivery, not because they aren't important, but I think at the conference and at previous conferences, this is where the conversation always lands and always falls on, and where a lot of the focus and energy goes. And I think we've unpacked a lot of these sub-points around the housing divide, how do we bridge the gap, what are the barriers to delivery or barriers to entry, whether you're a developer, a bank, and so forward. It's not really the focus of today's conversation. The one takeaway that's come to light over the last, call it 12 to 18 months, and taking over the association that we run in South Africa, is the access to credible data and information, and having a demonstrative track record that effectively lays out the risks and returns of not only residential and the affordable housing space, but more specifically the multi-family asset class. And I think where, yes, there's been a lag in terms of the maturity of the market relative to the other property subsets, so you look at industrial, retail, commercial, those have always been around, and they've been institutionalized a long, long time ago. Residential has always, to some extent, been the cousin in the equation that's come late to the table, where there is less empirical data or evidence that unpacks the risks and returns that attach to that asset class. And I think that's been probably one of the biggest barriers to entry. And in my career, unpacking it with investors and trying to raise equity has always been a really, really strong inhibitor. We've gone through an exercise as SAMRA where we've commissioned certain reports. The data that's shared in the slide deck is from MSCI, from a specific residential report that they packaged and published for us as the association, with the help of Diversity and ABSA Bank. CAHF is also undertaking a residential housing report for the multifamily sector as well, which will be published this year. Kesia's nodding her head, so she's committed herself. But that's another report that will be coming out into the market. And then there will be this ongoing basis where we refresh data fairly intermittently over time. Where we want the conversation to focus is very much around the access to institutional investors, which includes pension funds, but understanding why are pension funds important capital allocators and what does this do for them at the end of the day. And I think, again, going through the experience, one of the downsides or the shortcomings to the residential property space in getting real capital allocated has been a lack of proper specialist property operators or residential property operators that can credibly roll out and also be strong custodians of investment and funds. So again, from my perspective, for the association that we're running and who we advocate for as our member base, it's been a really, really important point to drive home with the institutional market, is that there are really, really strong developers, landlords, residential operators, not only in a South African context, but in an African context as well. I think what we can do is we can actually jump into the slides and go through a few of the bigger fundamental principles, and then we can touch on a bit of the data and revisit that framework slide at the end.
Cool, thanks Miles. So I just want to stand still on this for a second. So why do we say pension funds need residential rental assets? As I'd mentioned before, we need to kind of work out where all this capital is going to come from to fund, housing rollout in all of our various markets. And the argument that I'd like to put to you, because I think we as a sector and as an industry really need to go out and bang this drum, because it's going to take a lot of time to educate let's call it the capital allocators at pension funds around this point, is that residential rental property is incredibly well suited to pension funds in terms of their needs. And I want to tell you guys what I mean by this. If you look at most developed capital markets, like the US, for example, most European markets and some of the markets in the Far East, the institutional investors in real estate, which are mostly pension funds, obviously life insurers and some other companies as well, but these institutions that are investing large amounts of capital into real estate are disproportionately investing into residential real estate within their allocation. So in the US, the largest asset class in terms of institutionally invested real estate is residential. 25% of the US REIT sector is residential. And the reason for this is because pension funds in those markets have caught on to the fact that residential properties, rental properties, especially when they are large portfolios of institutionally managed residential, and we'll get into what we mean by that in a moment, portfolios of that nature are incredibly, they have incredibly predictable income streams. And if you're a pension fund and you're doing 30 to 50 year asset liability matching, meaning you need to plan very far into the future for the beneficiaries who are taking out pensions with you today, then having access to something that you can invest in that gives you a fairly good line of sight of what that stuff is going to be worth and how much income is going to come out of it in 30 years from now is very valuable. And in emerging market contexts, like most of those on the continent, there are actually very few things that pension funds can invest in that give them that. Obviously, all pension funds buy government bonds, but you can only have so much exposure to local currency government bonds, and then you've kind of maxed out that allocation, and now you need to start looking at what else you can put your money in. And historically, pension funds typically like going for commercial real estate, office buildings, shopping centers, even more recently a lot of industrial property. But what guys have figured out in markets like the US is that those other real estate asset classes actually have far more volatile income over a long holding period. So to give you an anecdote, if you own a shopping center, it's probably great real estate today, and you've got 5 or 7, or if you're lucky, 10-year leases in place that escalate every year. So it looks very predictable. But if you're owning that asset for 30 years, there's going to be a reversionary event every now and then where that mall becomes obsolete and you need to completely rebuild it from scratch, or kind of give it a massive capex investment to bring it back up to speed. That's not the case with residential. Residential has these slow, kind of predictable income streams. So I'm going to try and speed up a little bit here. But the point I want to make is this asset class is very well invested by pension funds in other capital markets. And there's no fundamental reason why it shouldn't be the case in our markets. And we need to work in equipping our local pension funds with the data and the insights they need to realize, actually, we should be investing in this kind of stuff. And some of the information we want to share with you here today in the data is information that we put together in the context of SAMRA with the assistance of MSCI to specifically make this case for pension funds. It's kind of, you can think of this as a invest in residential real estate for dummies, the dummies being pension funds in this case. And we'll share the report with everyone here.
But I also think, going through the personal experience of having run a residential property fund over the last 6-7 years, but also through the pandemic, my personal experience was that through the most difficult times and through the hardest time in the market, Transcend, where I was previously CEO, our vacancies at a max were at about 9 to 10%. So occupancy is always maintained at a north of 90% level. In terms of distribution, because this is where it becomes relevant. We can talk about returns, we can talk about what the yield is, whatever, but the wealth managers absolutely love the business, and you can say that in the same breath, along with the pension funds that were invested in us, because we had consistent, predictable payout of our dividend. So where a lot of the property funds that were in the listed space were cutting back on distributions or holding back on their payments of dividends, and then leaking tax, Transcend, we managed to pay out 100% of our distribution every year, even through the 3 years of lockdown. We were in a position where our distribution only slid by about 8% year on year as a maximum, and by the time my time was done there, we had already gone north of that distribution level. We had no rental reversions in our portfolio whatsoever. So again, talking to, I suppose, Carl's point around the risk around your earnings and cashback earnings at the end of the day, is that there was never this pressure that I think a lot of the other property subsets face. You look at retail, you look at commercial property, and the experiences that they went through the cycle, whether that be through COVID or just through any sort of economic downturn. And I think residential has demonstrated its resilience through those difficult patches. So we can hop into the data quickly. So this plots residential return relative to risk in relation to the other property subsets. And I know graphs are often as easy as how much you've had time to study it or look at it. But I think the short story takeaway here is that from a return relative to risk, residential actually outperforms, other than industrial, all of the other property subsets. And I think this is the crux of it. It's not just a return game, it's understanding what are the returns of an investment relative to the risk profile at the end of the day. And what often gets missed is with residential, the misconception is that it is a high risk asset type, and especially on the rental side, you're looking after multiple leases or thousands of individual leases. Surely that's risky, but to the contrary, it's a method of credit diversification. So if you think about it, you've got a book of 5,000 leases, or how many leases that you've got on your guys' books. You've got a natural churn and a natural vacancy that works through that, but you've got a list of people and move-ins that can immediately fill that spot, versus a big anchor tenant who gives you notice, disappears in a month's time, and then all of a sudden you've got a 20% hole in your earnings 1 month after they've given you notice or broken a lease. So the risk return profile in relation to the other property subsets, I think is really, really interesting.
And I just want to point out, this is 20-year data globally. I must actually go and check the stat again. It's in the report of the asset value that's represented by this chart, but it is, I mean, it's a staggering amount. It's many tens of billions of dollars, and it may even be as close to $1 trillion of assets that MSCI tracks for this data, and I think it paints a very compelling picture for why guys invest in residential rental.
Then this lays out and I suppose again sector by sector, the total return basis. What's interesting here is residential based on the valuations, and I think the general feeling there is that residential is undervalued when it comes to institutional portfolios or large-scale portfolios. But what it does is it effectively presents the total return for each of those different property subsets. Now, resi, again, a property type that, in terms of maturity, has lagged all of the other subsets, sits very much in line with retail and hotel, and only really is outperformed by industrial, where we've seen, I think, strong performance over the last few years. Again, coming to a personal experience of value and I suppose total return and how these things should often be looked at or discussed. When you look at individual units, the ability to sectionalize and sell off individual homes or apartments into the open market, I suppose, is critical in terms of value preservation or having a value underpin. So with a lot of these income stream portfolios or funds, everything's driven by a yield or by a cap rate, all right? With residential, there's always a sanity check because there's an ability to move into a different market where an individual unit or an individual home has got a value to it at the end of the day. And at Transcend, over my time there, we actually went through a process where we took an allocation of stock, call it 20% of our portfolio, and we would sectionalize and sell that into the market to recycle capital through our balance sheet, but also as a proof around valuation and what it is that we're holding on our balance sheet at the end of the day. Then this just lays out the different components of return. I think a lot of it was explained in the previous slide with the valuation as well as the income yield components to return. But this is just a look since 2017 specifically to the residential sector. So when looking at total return, I think back to the years that have been fairly resilient, fairly defensive, and fairly consistent and stable in its return profile. And then the last graph is just the bounce back in terms of earnings that we've seen in the last few years, specifically in the residential sector. You can see a significant uptick there in terms of NOI and income growth in residential. And I suppose that's also a function of more recent popularity of the sector as well.
Cool. Shall I try and, are we being politely informed here of just how deep into the graveyard shift we are now? So I think we need to wrap up. Do you want to say something in closing, Milo, and then I'll summarize for us?
Yeah, so I mean, from my side, I suppose drawing it back to pension funds and to the why pension funds or why they would be needed and what would be in it for them. I think at the end of the day, we need significant capital allocation into the space. I think to see decent economic growth, you need a strong property sector. To have a strong property sector, you need strong investment behind it. There's huge runway in terms of residential as an asset class. And what that provides pension funds with, as we've mentioned, is obviously strong, consistent, sustainable cash-backed returns, an opportunity for diversification, but also the ability to be supportive of social impact, not only for the communities, but also just generally for the affordable housing market. So I think our job is over the next 5 years for very much to spend as much time campaigning in front of the pension funds, advocating for multifamily, and trying to get institutional support for an asset class that should be probably tenfold bigger than what it is in an African context.
Absolutely. So maybe just in closing, what I'd like to say is we obviously operate in the South African context, and the organization that Miles heads up, and I'm also on the board of it, is really aimed at educating our local capital market in South Africa around why, in particular, pension funds should be investing in this asset class. But I'd like to extend the invitation to everyone here who operates in another market and would like to get in touch and basically, hear from us how they can go and ram Resi Rental down the throats of their respective pension funds, because we'd love to chat to you. And we'll, if you go to the SAMRA website, it's SAMRA.co.za, you'll find this report with all the data in it there. I encourage you to have a look at it. I think the bottom line is everyone here really cares about seeing greater housing delivery. We've spoken a lot in the last 2 days about capital availability and the fact that it's expensive to build housing. We need a lot more of it. And I guess the point that we'd like to put forward is, fortunately, this asset class is actually also fundamentally very well suited to pension funds. It's our collective task to go and help them understand this, and we're happy to help as SAMRA. Cool, thank you all.
Do you want to take a question?
We've got time for 1 or 2 quick questions. We go over here.
Yeah, thanks, Miles and Carl. I think it's a fantastic presentation. Definitely check out the report. I think mine is more of a comment. In my previous life, we were involved in trying to pull pension funds into real estate. Challenge that we found was not even the returns, it was the who. Because we realized the way the pension fund...
Sorry, say that? The who?
Yeah, who was making the decision. Because the way the pension fund industry in Kenya is set up is that the final sign-off of the investment is by trustees. And trustees are the respective sort of professionals who the pension funds collects money from. So the teachers, doctors, nurses, and if they don't understand these numbers, then you never get the sign-off for the investments. All the guys who are doing the pension fund management, the guys who understand finance, the guys who are more conversant with this, they will understand that. But if you sit in front of a nurse or a lecturer and try to, educate them in terms of why they should invest in affordable housing as opposed to government bonds, they don't see it that way. So that's where we are stuck, at least from a Kenyan perspective, in terms of spending time to be able to, educate the trustees.
Is that in Kenya?
Yeah.
So I know IHS has raised some pension fund money through County's pension fund. And I mean, that's very much a first in. But I suppose one of the big takeaways as well is that the more capital allocation you get from pension funds, it's also an opportunity to crowd in new equity and new capital as well. So it's, it's that whole follow-on approach. If you get one in, then to tip the next one becomes easier and easier, and that helps build that track record over time.
That's absolutely happened in South Africa. 5 years ago, there were, maybe you could count on a couple of fingers of one hand, the pension funds that were invested in this market. Today, there is almost, I want to say, not a pension fund in South Africa that isn't either knocking on our door or is seriously pursuing a strategy of getting into the space. So it happened essentially, I mean, it was like Paul here, who's been in the industry for a very long time in South Africa, will probably say it takes a very long time to create an overnight success, but we are fortunate in South Africa that we are now kind of at that overnight success moment, and it becomes a thing of guys not wanting to miss out once they see everyone else starting to do it. But I agree with you, there's an incredible amount of education of, in particular, the trustees and the asset consultants that are needed around this, and that's why in this report that we've done, we are pointing to the international experience to say, there's nothing fundamentally different about our markets that means it can't work. Sorry, I know I'm hogging the mic a little bit here, but I just want to say one last thing. The report that CAHF is working on for us, which will be coming out later this year, as we've heard, I think speaks to a lot of the other parts of the ecosystem that need to work and that need to be in place for this asset class to work. Because it's all good and well to get the pension funds on board and get them excited about it, but if there isn't a deep sector of operators who can rent the stuff and like manage them and collect the rent, if there aren't developers who can build the stuff, if there isn't, you know, all the various bits of the ecosystem that's required for this asset class to work, then it's pointless. And the report that's coming out a bit later this year, which you guys should keep an eye out for, speaks to what are those other, you know, areas of this thing that's needed.
Absolutely. Thank you very much. It was great. Good.